You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. On today's episode of the Learn Like a CPA podcast, we're going to be talking about why I think real estate is the greatest investment out there. Normally you'll see people throw around 3 to 4, maybe 5 key terms when talking about real estate. I like to break it down to 7 different ways I think real estate's the greatest investment. Number 1 has to deal with equity capture at the buy. So real estate is what's known as an imperfect market. I originally learned this while I was still in college. And an imperfect market, there's an imperfect market and there's a perfect market. A perfect market is like the stock market. You're going to look at a ticker, Apple, Google, Facebook, whatever it is. Somebody else who is thousands of miles away from you is going to look at the same ticker and get the same price on the same day. That's a perfect market. An imperfect market is something like real estate, where there's multiple real estate agents involved. There's buyers and sellers of all different types of experience and level and depth of knowledge. And that's why real estate, you're able to find deals in real estate where you're not necessarily able to find deals in the stock market. And equity capture at the buy is where you purchase a property that you purchase it less than what it's actually worth, and you're able to capture equity, and your net worth is going to go up by doing so. The second benefit is, of course, cash flow. A lot of people talk about cash flow. I think cash flow equals freedom. Equity will give you options, but cash flow will equal freedom. When you have cash flow coming in from rental properties, it makes it easier to kind of do the day-to-day stuff that you want to do. It's less stringent of a requirement to collect rent and receive checks than it is to go and work at a day job. Number 3 is market appreciation. So as you're holding onto that property, the property is going to go up in value. And typically the annual appreciation is, you could expect 2 to 3% per year annually. Now, you might see higher appreciation if you're going to force rehab something or stabilize the property. But on average, you could expect 2 to 3% of that purchase price to appreciate in value. Leverage. Leverage is where you are using what's called other people's money, or OPM, to produce returns for you. So if I have $50,000 and I want to invest it in the stock market, I'm only seeing a return on $50,000. I'm getting dividends on $50,000. I might be getting interest income on $50,000. I'm getting appreciation on $50,000, but that's it. With leverage, I'm able to take my $50,000 and buy something, say, that's $250,000. And with my $250,000 asset, my rental property, if that appreciates 2% per year, I'm going to get a much larger return than if my $50,000 was to appreciate 2% or go up 2% in value in the stock market. So leverage and market appreciation kind of go hand in hand, because you're able to see higher returns in real estate as opposed to the stock market due to leverage. Another benefit is principal pay down. So as you're servicing the debt, as you're holding on to that property, the tenants or the guests, whoever's staying at your property, they're going to be helping you pay the principal payment, your principal pay down. That's going to boost equity in the property over time. One thing a lot of people don't talk about is inflation hedge. At least I call it an inflation hedge. Real estate's an inflation hedge because over time, when I buy a property, assuming I take out debt for it, I'm locking in a fixed monthly payment, typically over 20, 30 years, and that monthly payment is not going to change. And normally right now, especially if you're locking in rates as low as 3%, if inflation's running higher than the interest rate, you're actually making money because the money that you're paying back over time is worth less. So an example would be, if I have a $1,000 a month mortgage and I make a $1,000 payment every single year for 30 years, well, over time, as inflation creeps up, the money that is coming out of my bank account is actually worth less. So in essence, I'm making a spread on the difference between what my interest rate is and what current inflation is running at. So right now, inflation, they just announced, was close to 7%. If I'm borrowing money at 3% and inflation is running at 7%, I'm essentially capturing that 4% spread. And of course, the one that we're going to get into more is the tax benefits. Robert Kiyosaki says there's two different tax codes. There's one for the uninformed and there's one for the informed. And you have to decide which spectrum you're going to be on. Tax benefits such as you're able to take depreciation, we're able to long-term capital gains, 1031 exchanges, accelerated depreciation, monetize installment sales. There's so many tax benefits that occur in real estate that you just do not see in other sort of asset classes. And that's what we're going to go to dive right into now, is how exactly the U.S. tax system works. So I mentioned that there's a tax code for the uninformed and then there's a tax code for the informed. You have to look at the tax code as a roadmap to wealth. Congress writes the tax code. The IRS and the state governments, they just enforce their own tax code. So it's Congress who sets out the principles. Congress makes the rules. The IRS just enforces it, right? But what is actually in that code? And you'll find really quickly that the tax code incentivizes three different behaviors. It incentivizes business creation, because business owners are going to create jobs for other people. They're going to provide a product or a service for that environment that they're in, where consumers are going to be able to use their product or service. It's going to create jobs. You're going to need buildings, more creation. The tax code incentivizes investing, right? Stock market investing, retirement investing. There's incentives in the tax code for investing. So that's number 2. And number 3, the tax code incentivizes real estate owners. So one thing you'll find with owners of real estate is most of them don't pay taxes. If all they have money coming in is from real estate, from passive income sources, a lot of them are not paying taxes because of how beneficial the tax code is. Now, when we talk about different types of activity or different types of income, there's 3 categories of income, but there's only 2 buckets of income. And what I mean by that is, one of the categories of income is ordinary income. Ordinary income is money that you get at a day job. Maybe you're self-employed. Maybe you have gambling income. That's ordinary income. Now, if you're working a day job or if you're self-employed, you're going to be subject to FICA taxes. So I consider FICA tax a working man's tax, because you're paying into Social Security and Medicare. And if you're a W-2 employee, that's 7.65%. If you're self-employed, it's 15.3%. That is on your gross wages. Now, passive income through real estate doesn't have FICA taxes. So right away, you're going to be paying 7.65% less if your money's in real estate, as opposed to if you were to show up to work and make that income. So we have ordinary income, we have passive income, and then we have portfolio income. Portfolio income is money from dividends, interest, stock capital gains. And what you'll find is the name of the game becomes, how quickly can you move your income source from ordinary activities where they're taxed at the highest rates. Ordinary income activities are taxed at the highest rates, and there's very little things that you can do to offset ordinary income activities. If you're just a W-2 employee, there's little things that you can do. You could do HSA accounts, you can do retirement accounts, you can have more babies. That's about it. When you're ordinary W-2 activity, there's not much you can do. Now, when you're heavily invested in real estate, it opens up a ton of doors for you to kind of use the tax code to your advantage. There's tons of opportunities there that you can do as a real estate investor that aren't open to just your standard W-2 employee. We're going to get into expenses. So one of the things about being a business owner or a real estate owner is you're able to get a tax deduction for your expenses, any sort of expense that you have for the business. Now, it's important to understand that expenses are not free, okay? Expenses are a reduction in the tax liability that we owe. The way I explain it is, think of it like a coupon. If you were to have a coupon for Target or Walmart or CVS, the government is giving you a coupon that's equal to your marginal tax rate. So if you want to figure out what your marginal tax rate is, you have to figure out what your income level is, and your marginal tax rate is how much taxes you pay on the next dollar that you earn. So I will just use my example. I'm in a 24% federal tax bracket, and I'm in about a 5% state income tax bracket. So 29%, I'm going to round it up to 30 just to make the math easier. So the government is giving me a 30% coupon to go out and buy do the things that I need to do for my business or my real estate. And in return, I'm going to get a tax deduction for that. So if I go out and have $1,000 expense, maybe I need to hire somebody to do some plumbing, and I have $1,000 expense, my after-tax cost is really $700 because that $1,000 is going to reduce my tax liability. If I was to show $1,000 more of income, I would have to pay taxes on $1,000. But because I have it as an expense, it's a reduction in my tax liability. So my after-tax cost becomes $700. We don't want to let the tax tail wag the dog. And I say this because you don't want to make a business, an investment, a real estate decision solely for the tax benefits. You want to make sure that it's a sound investment decision in the first place. And don't just buy something because it's a write-off. If you don't actually need something, don't buy it just for the tax deduction. It's important to understand that expenses need to be what's called ordinary and necessary. And there's two sections of the Internal Revenue Code which try to outline this. It's Section 162 and Section 212. Those kind of garner, when you have expenses for a business or a rental property, that it needs to be ordinary and necessary. So the way I explain ordinary and necessary is it may be ordinary to need a car, or let's say I'm a dentist. It's ordinary for me to drive from my house to my dental practice. Is it necessary for me to have the newest $130,000 Mercedes or $130,000, fill in the blank, right? Probably not. So there's ordinary and necessary. And another example is I own a remote CPA firm. So we serve clients nationwide remotely. I have no business purpose buying a vehicle because I don't drive anywhere for a business activity. So when you're making these deductions and these expenses, make sure that you actually have an ordinary and necessary need for that. Some of the items that you can deduct as a real estate investor, this is not wholesome. I'm just going to list off a few. You can do advertising. Maybe you pay money to somebody to get your property rented, so you pay like tenant fees, cleaning and maintenance, management fees, utilities, insurance, legal professional, repairs, supplies, city taxes, property taxes, mortgage interest. The list goes on, so as long as it's an ordinary expense for your business. I will say the best expense for a real estate investor is depreciation, and that's what we're going to go into talk about a little bit now. Depreciation is the government's way of understanding that the value of your property is going to go down over time. The components in that property are going to lose value, and depreciation is the government's way of giving you that as a tax deduction. It's kind of this weird little thing because we know real estate tends to appreciate in value, but then the IRS turns around and says, actually, your building goes down in value. But nonetheless, it's great for us as investors because we get a deduction for it against our income. So depreciation is a non-cash expense that offsets our income. The easiest example is, let's say I rent out a property for $12,000 a year and my depreciation comes out to be $10,000 a year. Okay, that's a phantom expense. I don't have to come out of pocket for that, but I get a deduction against my taxable income, and then I pay less in taxes. So instead of paying taxes on $12,000, I only pay taxes on $2,000 because I get $10,000 of depreciation. Now it's important to understand that depreciation is only assessed on the building structure or the amount that's allocated towards the building. You can't depreciate land. They do not let you depreciate land. So to give you an explanation, let's say I buy a $200,000 purchase price property, and of that $180,000 is associated to the building structure and $20,000 is associated to the land. I'd be able to depreciate the building, but not the land. And depreciation is you normally take the building value divided by 27.5 if it's a long-term rental, or 39 years if it's a short-term rental or a commercial building. One of the things with depreciation that we talk about is it's a non-cash expense. It is the best thing out there for real estate investors, and it's something that doesn't happen if you're just a W-2 employee. Now, you could be a W-2 employee and also own real estate, and you're going to have depreciation on your rental income. But this is just an example of something that's in the tax code for real estate investors that if you're just a W-2 employee, you're not going to be able to take advantage of. Thanks for tuning in to today's episode, guys. In the next episode, we're going to talk about depreciation recapture, as well as we're going to get into cost segregation studies. If you want to make suggestions on what we talk about on the podcast, please reach out to me on Instagram and Twitter at LearnLikeACPA. That's where I'm most active. Until next time, thanks again for tuning in.